You were not planning to sell. That is the part that makes it feel different. The stock was down. The account looked ugly. The number on the screen made your stomach tighten. But in your mind, the decision was still yours. You were going to wait. You told yourself the usual things. It is only a bad week. The market overreacted. Long term, this will probably come back. Then you opened the app again. And the position was gone, not down, not waiting. Gone. Sold. Closed before you decided to let it go. At first it feels like a mistake. Maybe the app is wrong. Maybe you tapped something. Maybe the order history will explain it. Then you see the word that changes the whole story. Margin. This is the part of a margin call most people do not understand. Suddenly, the loss feels different. Because losing money is painful, but losing the right to decide is something else. This is how many investors first understand margin. Not from a lesson, not from a textbook, but from a sale they did not choose. They thought their brokerage account was just a place where they owned investments, but something else had been true underneath. They had buying power. They had leverage. They controlled more stock than their cash alone could buy. And in exchange, the account quietly gave the broker the right to protect the loan first. That is the part most people miss. A margin call is not just a warning. It is the moment your account reveals who has control. Buying power is how much the app lets you buy. Holding power is how long you can survive a bad market without being forced to sell. Margin can give you more buying power, but it can quietly take away holding power. And for an investor, that difference can change everything. Margin looks simple from the outside. You have $5,000. Your broker lets you buy $10,000 worth of stock. That is called leverage. Leverage means using borrowed money to control a bigger position than your cash alone could buy. At first, it feels powerful. You put in $5,000. The app shows a $10,000 position. And when the market is going up, that feels smart. But the extra $5,000 was not a bonus. It was not free money. It was a loan from the broker. And the stock inside your account became collateral for that loan. Collateral means the asset protecting the money you borrowed. That is the quiet trade. You gained buying power. But the broker gained a claim against the account if things went wrong. In a cash account, your stock is just your stock. It can rise, it can fall, it can embarrass you. But unless you choose to sell, you usually still have the ability to wait. In a margin account, that same stock has another job. It does not only represent your investment, it also protects the broker's loan. Nothing about this has to be evil. The broker is not breaking the rules by protecting the money it lent you. That is the agreement. But emotionally, it feels strange because you still look at the stock and call it mine. My shares, my position, my portfolio. And in normal conditions, it feels true. But once margin is attached, ownership becomes conditional. It is still your account. But someone else now has a key, a clause, and the right to act first when the account gets too weak. That is why the real danger of margin is not only that losses get bigger, it is that your ability to wait can get smaller. Now imagine that $10,000 position falls to $7,000. The market is down. You are frustrated, but you still believe you can wait. The problem is that the broker is not looking at your patience. The broker is looking at the loan. You still owe the borrowed $5,000, but now the account is only worth $7,000. Your cushion has shrunk. And if that cushion falls below the broker's requirement, the broker may not have to wait for you. Most people imagine a margin call like a polite warning. Your account drops. The broker sends a message. You get time to think. You decide what to deposit. You decide what to sell. You stay in control. But your broker may not be required to handle it that slowly. The broker may be allowed to sell securities in the account. It may not have to wait for your permission. It may not have to let you choose which position gets sold. And it may sell more than you expected if that is what reduces the loan risk. That is the part that should make every beginner pause. The broker's job is not to protect your long-term thesis. It is not asking whether the stock is undervalued. It is not asking whether the market is panicking. It is not asking whether you plan to hold for 5 years. It is asking one colder question. Is there enough collateral? If the answer is no, your plan can stop mattering. That is why a margin call feels so different from a normal loss. In a cash account, a falling stock hurts. In a margin account, a falling stock can start making demands. The market does not need to destroy your stock. It only needs to move enough for the rules underneath your account to activate. And when those rules activate, the sale you did not want can become the sale you already made. Most people do not discover margin in a calm market. They discover it when everything is already moving. The market is rallying. The chart is green. People online are posting gains. The stock you almost bought last week is already higher today. And in that environment, margin does not feel like debt. It feels like a smart move. You are not thinking, what happens if this falls tomorrow? You are thinking, why am I sitting with unused buying power while everything is going up? That is how the trap starts. Not with stupidity, with confidence. Imagine you have $5,000. In a cash account, that is the size of your position. But with margin, you may be able to control $10,000 worth of stock. If the stock rises 10%, the bigger position makes the gain feel smarter. Your account looks stronger. Your decision feels validated. Your brain does not say, I borrowed money. It says, I was right. That is the dangerous part. Margin rewards you first. It lets the upside feel real before the downside feels possible. A rising market makes risk feel smaller than it really is. It makes borrowed money feel like opportunity. It makes hesitation feel like weakness. And your mind starts doing something strange. It calculates the upside clearly, but it keeps the downside blurry. You imagine the extra gain. You do not fully imagine the forced sale. You picture the profit. You do not picture opening the app and seeing that the decision was already made without you. When the chart is green, leverage feels like intelligence. You bought more. The position went up. Your return looks better. Your confidence gets confirmed. And once confidence gets confirmed, it stops feeling like risk. It starts feeling like skill. But the market does not need to punish you immediately. It can let you feel right first. Then, when prices turn, the same feature that made you feel smart starts taking away choices. The extra buying power becomes extra pressure. The loan is still there. The collateral is shrinking. And now, the broker is not reacting to your confidence. The broker is reacting to the account. That is the psychology of margin. It does not need you to be reckless forever. It only needs you to feel certain at the wrong time. So the answer is not to memorize every margin rule. The answer is to protect holding power first. Holding power means your ability to survive a bad market without being forced to sell. That is the real asset. Not the bigger number on the screen, not the extra buying power, not the feeling that you can control more stock than your cash could normally buy. Because buying power helps when things go right. Holding power saves you when things go wrong. So before using margin, ask one simple question. If this position falls tomorrow, can I still choose to wait? If the honest answer is no, the position is not really under your control. Start with your account. Check if margin is enabled. Then check if you are actually borrowing. Do not confuse available buying power with real cash. A brokerage app may show you a bigger number, but that does not mean the money belongs to you. Some of it may be borrowed, and borrowed money comes with conditions. Then look outside the brokerage. Imagine your core monthly expenses are $4,000, but outside the market, You only have $2,000 in cash. That does not mean you have an investment problem. It means you have a breathing room problem. If the market falls and your margin account starts making demands, you do not have much time, cash, or emotional space to respond calmly. That is why cash outside the brokerage matters. Not every dollar has to be invested. Some dollars exist to give you time. And time matters because time is what forced selling takes away. If your income is unstable, if your expenses are high, if the market is moving fast, or if you feel emotionally desperate to catch a move, margin becomes more dangerous. Because the worst time to borrow control is when you already feel out of control. The rule is not that margin is always evil. The rule is simpler. Never let borrowed buying power weaken your ability to wait. Go back to the beginning. You were not planning to sell. You were planning to wait. In your mind, the stock was still yours, your position, your account, your decision. But the sale was not random. It was not necessarily a glitch, and it was not always a betrayal. It was the agreement working. That is what makes it uncomfortable. The account protected the loan first. And once you understand that, the word mine starts to feel less simple. Because in finance, ownership is not only about whose name appears on the screen, it is also about what conditions are attached underneath. Your stock can be yours, but tied to margin rules. Your house can be yours, but tied to a lender. Your car can be yours, but tied to a payment. The object may look like yours, but the conditions decide how much control you really have when life gets tight. That is the bigger pattern. Some financial tools are sold as flexibility, more access, more speed, more buying power, more room to move. But sometimes that flexibility comes with quiet conditions. And quiet conditions are easy to ignore when everything is green. They only become visible when the market turns. So the real lesson is not just avoid margin. That is too simple. The real lesson is to ask a better question. Not how much can I buy, but how long can I hold if things go wrong? Because buying power looks like freedom. Holding power is actual freedom. And once you understand that, the word mine changes. My stock, my account, my decision. Those words only stay true when you still have the power to wait. The system was always running. Now you know how to read it.